In more uh, advanced versions of this that you would see in advanced master's or PhD level classes, we do worry about that issue. But in this simplistic case, that's kind of what we're looking at. But allows us to estimate proper required rate of returns for owning stocks or portfolios of stocks. There are a few implementation issues. One, what is the risk-free rate and where do I get it? And two, how can I estimate the beta for a given portfolio? And these are not simple issues, but we kind of developed in practice some shortcuts. One, ideally, you would use return on short-term treasury bills as the risk-free rate. But in practice, we tend to use actually, there's a third issue. Where do I get an estimate of expected return on the market portfolio? I mean, it sounds rather nice in practice, but let's handle the first one. What's that risk-free rate? If our investing horizon was only the next 3 months, obviously, 3 month treasury bill rate would be the proper risk-free rate because there is no default risk since treasury will always pay, even if they had to print money or mint coins, they will pay. Uh, and there's no price risk. But as I said before, in this simple model, there is no inherent concept of time. There is now and later. To the extent that stocks and most assets are uh, long-term investments, it may not be a bad idea to use kind of a reference rate as a long-term treasury bill, 10-year treasury bonds, yields, maybe some average during the previous 3 months or so, because you don't want your estimate of risk-free rate to change every day. Because, 10-year treasury bills move around. I mean, let's see how they moved around the last week or so, last 3 months or so. Just today alone, they moved up by about 6 basis points. And roughly speaking, that means treasury bonds lost about 0.4% of their value, roughly speaking. But if you look at over the last 3 months, they moved anywhere from 433 to about 396 about 2 weeks ago. So if I'm using this in practice, I don't want to use it on a day-to-day basis. Remember, we are going to use these to estimate values of not only the stocks based on either something like dividend growth model or residual income model, but also use them as part of the cost of capital in projects. I mean, I don't want my project decision to change just because Trump did not have a good election day yesterday. That's the reason behind that jump today, because market is anticipating that Trump is going to respond to that in one fashion or another. Whether you agree with that or not is besides the point. Market is thinking uncertainty has increased, so they want more compensation in terms of 10-year rates. On the other hand, if you look at the 1-year rates, even those have increased a bit, but not as much. And since it's 1 year, your 1-year bond value is not going to decline more than 0.0035%. Okay, so they're not as sensitive. So that's number one. Number two, we use statistical models like linear regression to estimate beta for each company, for each asset. Since we have historical returns for both asset in question and the market portfolio, which we haven't addressed yet, but we will. If you think about it, if you take this equation, you can rewrite this I should say Rm plus some random error term. Just because their expected values are the same doesn't mean that this equation is going to be satisfied exactly historically. It basically says on average, uh, your excess return on a stock should equal to a multiple of excess return on the market portfolio. That doesn't mean every single period that's going to be the case. Did they talk about linear regression in your stats classes? I'm not sure you even have to take that class before this, but if you did, this is basically what that means. I'm not going to ask you to do any of that in this class. Uh, typically, uh, financial info publishers estimate these equations, these betas, using data from last 5 years or so. And that's also important because remember, the model theoretically doesn't have a concept of time, but we live in an environment where things change over time. Think of Google in 2004 when they went IPO first. Do you think Google was riskier then or now? Anyone? They had not even bought YouTube. They were just a search engine. They had started making some money selling ads. So if you think about it, 2004, Yahoo was still a threat to them. I don't know why it ever was, but at least on paper it was. Google in 2004 was a very risky investment. Who knew that anybody would actually pay money to put ads on Google searches? I didn't. Back in 2011, 12, when Facebook went IPO, nobody had any idea that people would put on ads on Facebook.